Hello, Mindsetters. Welcome to your grade 12 accounting lesson. I am Looney, and with me today is Martin.
Hello, Looney. How are you doing?
Hi, I'm good. How are you?
Very well, thank you.
Are you glad to be back in South Africa?
Yeah, very glad to be back in South Africa
Glad
and ready
be back
to go
with
again.
the Mindsetters?
Very glad to be back with the Mindsetters.
Okay, so what are we doing for the Mindsetters today?
Okay, so today we're doing fixed assets and inventory valuation.
All right, Mindsetters, I hope you guys are excited for your accounting lesson. Remember to hit us up on Facebook, on facebook.com/learnextra, and then you can send us your tweets at learnextra, and then you can download all the videos, the schedules, and the notes on learn.mindset.co.za. And if you want to win yourself this awesome Cassia calculator, all you need to do is complete the test yourself section from the notes, but there is a separate link on our Facebook page, so you click on that link, it will take you to the test yourself questions. You fill in all your questions, you fill them incorrectly to stand a chance to win the Cassia calculator. So with that said, let's take it back to Martin for a great accounting lesson.
Thank you very much, Looney, and Mindsetters, get going on that calculator, because remember, an accountant without a calculator is like a dentist without a drill. So today we're going to be dealing with what we call our assets and our inventory systems. And this is a section, Mindsetters, that you will be familiar with from your grade 11 work, but it's also a section that many people sometimes just ignore because it's usually quite a short section in the textbook. It's usually just a couple of pages on periodic and perpetual inventory system and on FIFO and weighted average system. But please, Mindsetters, don't ignore this section. This section is very, very important because a question can creep in somewhere and you need to be able to know what you're doing. If you know what you're doing, it is quite easy. So let's take a look at what we're going to have to cover today. First of all, what's very, very important is to understand the differences between our periodic inventory system and our perpetual inventory system. So I just want to talk about that for a couple of minutes, just to tell you that we've got two inventory systems that we as a business can use in our books. And the one that we're most familiar with, that we've been doing since usually grade 10 and even maybe earlier if you've done EMS in grade 9, is what we call the perpetual inventory system. The perpetual inventory system is the one that you're familiar with, where you always calculate your cost of sales every time a sale has been made. So with the perpetual system, you record cost of sales every single time a sale is made, and you keep a special trading stock account. So I'm not going to go over this in full detail because you will remember this. This is the system that we normally use when we sell something. What we do is we credit sales and debit either bank or debtors control. And at the same time, we're also going to credit trading stock because we're selling stock and debit our cost of sales. So please make sure you remember that system. That's the usual one that we use. But sometimes, every now and again, a question will crop up where the system that we use is actually the periodic system. And if you look at the periodic system, the word periodic contains the word period, P-E-R-I-O-D. What this means is that you only calculate your cost of sales at the end of the accounting period, or the period in which you calculate your gross profit for the year. So what that means is that we don't keep track of cost of sales on a daily basis. We calculate it using our special formula, which I'm going to show you just now. We calculate it at the end of every period, be it a month, be it a year, be it a week, however many periods you want. That is when you're going to use the periodic system to calculate your cost of sales, and you will only value your trading stock at the end of every period. So please be sure that you understand the difference between those two. Just to recap, the perpetual system, we value our trading stock at the end. Every single time that we sell something, we keep track of the value of the trading stock that we have sold, and we also keep track of our cost of sales. But periodic system, we don't do that at all. We just keep track of our sales and we keep track of our debtors control or bank, but we don't do the other entry with cost of sales and trading stock. We only calculate that at the end of the period. So that is the difference between the two. And just now in the challenge question, I'm going to ask you to give some advantages and disadvantages of the two systems. Also, what's important, go and make sure that you revise how to do the trading account. Remember, we have got at the end of the financial period, we create a special ledger account called the trading account. And our trading account is our usual T account which we use to calculate our gross profit. You would have seen the trading account at the end of grade 10 when your teacher taught you the various closing transfers that we do at financial year end. Usually it's very easy. Under the perpetual system, what we do is we credit it with the amount from sales, which is closed off to there, and we debit it with the amount of cost of sales, which is closed off to there. And then what we do is we calculate sales minus cost of sales is going to give us a balance brought down over on the debit side of this account. But instead of calculating a balance brought down as per usual, this balance is transferred to the profit and loss account as our gross profit. I'm sure I don't need to tell you how to do that. You would have seen this before in grade 10 normally. Now, that's the perpetual system. Under the periodic system, remember, we don't have this cost of sales account, so the trading account looks a little bit different, and that is what you would have to make sure you understand. So you'd still close off your sales there as normal, but what we do is we close off a whole lot of other different accounts there. To calculate cost of sales, we use a special formula, and what would happen is we would put over on this side our opening stock. We would put over here our purchases, because remember, in the periodic system, we have a brand new account called our purchases account. We would also put on this side any other purchasing expenses, any customs duties, or any import duties would appear on the debit side of the trading account if we have them. And then finally, we would put our closing stock on the credit side. And what would then happen is we would balance the account out and transfer it to profit and loss as usual. So make sure that you understand the difference between the periodic and the perpetual system when it comes to drawing up the T account for the trading account. That's quite important. Okay, then what's important as well, in the periodic system, you need to understand the use of the purchases ledger account. This is a new ledger account that we have in the periodic system, and basically what it does is it replaces our trading stock account. Instead of recording purchases of trading stock as an asset in trading stock, what we actually do is we create a brand new ledger account, which is called the purchases account. And in this purchases account, what we actually do is we record all purchases of stock on the debit side over here. All returns of stock or donations of stock we record on the credit side over here, and that is the amount that then gets closed off to our trading account at financial year end. So make sure you understand how to do the purchases account. It's actually quite easy as long as you remember that it replaces the trading stock account. There's just a short recap of how the account works. If you're not sure, either send me a question on Facebook or on Twitter, or otherwise what you could do is just look in your book again, the format of this purchases account to make sure you understand it. Also very important are the two opening stock and closing stock accounts. Remember, under the periodic stock system, we do not keep track of our trading stock every single day. We only calculate it at the end of the period. So your opening stock would be the value of your trading stock at the beginning of that period, and the closing stock would be the value of your trading stock at the end of that period. And the way we actually determine this is usually just by doing a physical stock take. So what you do is you count your stock at the end of your financial year, you work out its value, and that value is going to be your closing stock, and the closing stock at the end of this year is going to get closed off to my trading account like that, and then at the beginning of the next financial year, that is going to become my opening stock. So just like in a cash budget, this month's closing bank balance becomes next month's opening bank balance. The same is going to happen with our stock. This year's closing stock becomes next year's opening stock. So that you get these numbers actually by doing a physical stock take, and whatever is in the physical stock take, that tells you how much your trading stock would be at that particular time. Okay, now what's also very important, and what I'm going to go through in more detail, is to understand the difference between the FIFO, which is first in, first out, and the weighted average methods of valuing stock. So I'm going to go through those in detail. That's something that you must know how to do, because if there's a question, it's usually going to be between 6 and 10 marks to calculate something on the FIFO or the weighted average method. But I'm going to show you how to do that when we go through our exam practice question. But please, mindsetters, make sure you understand the difference between these two. And another thing that's very, very important to remember, if you're studying this in the textbook, you will usually have the periodic and the perpetual system. Let's get them up on the screen. Here's the periodic system and the perpetual system. You would have those to study, and you would also have to study the FIFO system and the weighted average system. And sometimes students get a little bit confused, and they think that FIFO goes with perpetual and weighted average goes with periodic, or vice versa, or something like that. Please, please, please understand that those four concepts are four separate concepts. Okay, the first thing you need to know is that when you're choosing an inventory system means when are you going to calculate your cost of sales and how are you going to calculate your cost of sales. If you're choosing an inventory system, you have the choice between periodic and perpetual. So you choose one of them and you stick to it. Then when it comes to valuing your stock, in other words, valuing your opening stock or valuing your closing stock, you've got a choice of two methods of what you're going to use for stock valuation. That can be first in, first out, or it can be weighted average. So it's perfectly possible to use the periodic system with FIFO and the perpetual system with weighted average. And it's just as possible to use the periodic system with weighted average and the perpetual system with FIFO. So any combination of those four is possible. So please do not think that the perpetual system always goes with either FIFO or weighted average, because that is not true. Make sure you understand these concepts. They are very important. Then, what's also finally very important here, last point I want to make, is that we have to usually calculate four different things. First of all, we usually have to calculate the value of our closing stock using either FIFO or the weighted average method. Then we also have to calculate our cost of sales, also either using FIFO or the weighted average method. And I just want to throw a question out to you there. Is there anybody who can maybe send us the answer on Facebook? What is the formula for cost of sales using the periodic inventory system? I'll give you one little clue. It starts with opening stock. So I'll tell you the answer to this later on. See if you can tell me what is the formula for cost of sales under the periodic inventory system. Then, also what's important is to be able to calculate your gross profit under both systems. And then finally, you need to be able to calculate the number of units of stock that there is on hand. So in other words, how many units of stock do we have left over? Make sure you understand how to do those four calculations, because those are typically the four things that they ask, and usually it can be a question that's for quite a few marks because it involves a series of calculations. So without any further ado now, I've revised what we need to know in this section. Please see if you can answer our challenge question. So first of all, see if you can explain to us one advantage and one disadvantage of using the periodic inventory system as opposed to the perpetual inventory system. This is a question that I've often seen in past exam questions where somebody would say, so-and-so is an inexperienced bookkeeper who is trying to run a business, and she asks you for advice on whether she should use the periodic system or whether she should use the perpetual system to try to value her stock. And you have to give some advantages or disadvantages of both of those methods. Remember, if you're asked to give an advantage of one system, an advantage of the periodic inventory system would also obviously be a disadvantage of the perpetual inventory system. So see what you can do, maybe draw up a table and see if you can name more than one advantage and more than one disadvantage of using the periodic system as opposed to the perpetual one. And let me give you one clue. Please remember that under the periodic inventory system, we only keep track of our trading stock at the end of every period. So we don't know its value every day. We only calculate it and count it at the end of every period. Think in your minds what could possibly be a disadvantage or an advantage of using a system like that. So before we get to the exam question, Looney, I think it's about time for a break.
All right, I'm going to take a break. Mindsetters, you are going to take a break. Quick congratulations goes out to Martin Madley from the grade 12 geography show for winning a Casio calculator, and Recta Khapana, you have won yourself a Casio calculator from the grade 12 accounting show from last week's Taste Yourself competition. Congratulations to you guys. Let's take a very quick break and we'll see you straight after this. Welcome back, Mindsetters, from that break. Just to let you know, we are in round 3 of the Get Connected competition. So that means fresh new teachers and fresh competition, because we want you guys to get connected and stand a chance to win Vodacom airtime and a Sony Xperia R. So our teachers are for this week: Dina, Tracy, Cheryl, Michelle, Peter, and Ashraf. So all you need to do, step 1, is to go to the Curio link that is on the graphic. Then you click on that link, you fill in learn, you pick your favorite teacher from all those teachers that I've mentioned, one teacher. Then you go back. So if you've chosen Ashraf, then you go to Ashraf's link, you will get to Ashraf's graphic and you will like Ashraf's picture. Then you go back to the competition graphic and you share that with all of your friends to stand a chance to win Vodacom airtime. And then all those people who have the teacher with the most likes, who've liked that teacher as well, will stand a chance to win a Sony Xperia R. So get connected, guys, and go to our Facebook page. Remember, you can go to learn.mindset.co.za/get connected to get all the competition details as well. Martin.
Thank you very much, Looney. So what we've been discussing previously is just the periodic inventory system, the perpetual inventory system, FIFO, and the weighted average system. Let's now put this into practice and look at an exam question. So here is a typical exam question, and it says here that you are provided with information relating to Tiger Music. Okay, so that's a music shop. For the financial year ended 28th of February 2010. This business is situated in Pretoria, and it says that the business sells music in the form of compact discs, in other words, CDs. And now what's important here is that we need to know that they use the weighted average system of valuing their stock, and what's important is that they use the periodic inventory method. Very important, mindset, is to read the question fully, study it well, to make sure that you know which inventory method is being used and which stock valuation system. So we're using the periodic inventory system and we're using the weighted average system of valuing the stock. So now that we know that, we're in a position to answer the first question. The first question says, calculate the value of the stock on hand at the end of the year according to the weighted average method. And we've actually just been given a completely blank page in which to do it. So sometimes you get given like a table or a stock control card or something in which you must calculate the value of the stock. But sometimes they can just give you the question completely blank and they ask you to do it according to the weighted average method, and then you see 8 marks. So this is quite a big calculation. It carries a lot of marks, and it's something that you need to know how to do pretty well. With the weighted average method, what you need to realize is the weighted average method calculates the value of the stock based on the average prices of all of the items that you had in stock at the time. So the best way actually to explain this to you is to have a look at the information and see what we've been given. So here's the information, and it tells us that the CDs on hand on the 1st of March 2009, and it gives us 3 different columns, and it firstly tells us that there were 2,500 units. In other words, on the shelves of this shop, there were 2,500 CDs on the shelves, and each one had a price of 70 Rand. So it's 2,500 units, each with a price of 70 Rand. And then over here on the right-hand side, we've got the total value, and they've given us the price of 175,000 Rand. Now, normally when you see a table like this, it can be a little bit confusing because there's so much information that's given to you. But it is actually quite easy if you remember that the units times the unit price, let's write it down, the units or number of units times by the unit price is equal to the total value. That should be quite obvious to you, because if I've got a shop with 2,500 CDs, and each CD is worth 70 Rand, how much are my CDs worth altogether? Very easy. You just multiply them out, and it should give you that answer of 175,000. I trust them, but let's just check that it is correct. So if we take the calculator here, I take 2,500 units, and they are worth 70 Rand each. That gives me a total of 175,000 Rand. The total value of the CDs in my shop at the beginning of the year, in other words, the end of the previous financial year, 2009, was 175,000 Rand. It's a lot of CDs. Okay, now, it tells us that we also have CDs on hand on the 28th of February 2010. So that's 1 year later, and it tells us that we have 3,020 CDs on hand. But now the rest of the information is missing. We don't have a unit price for the CDs, and we don't have a total value. We've only got question marks. So what that means is that we have to calculate those missing figures. It's very easy if you know your method, and the method that we're using is the weighted average method, as you'll remember. And let's have a look now at this schedule that they've given us. Here they've given us, in this box, which I'm highlighting here in yellow, they have given us the CDs that were bought on credit during the year. So we purchased extra CDs, and we purchased on the 30th of April 4,000 CDs at a cost of 60 Rand. So 4,000 times 60 would give us that total of 240,000. We purchased on the 31st of August 2009 3,000 CDs at a cost of 90 Rand. That gives us our 270,000. And then finally, on the 30th of November, we purchased 8,000 CDs at a cost of 80 Rand, and that came to 640,000. But now the question is, what value are we going to use to determine what our CDs on hand on the 28th of February 2010, what value are we going to use to determine what one of those CDs costs? And if this price was all the same, let's say it was 70 Rand, 70 Rand, 70 Rand, 70 Rand, then it would be very easy, because we know that one CD costs 70 Rand, and we would just write 70 Rand over here, and we would multiply it out, and we would know the total value of our 3,020 CDs that we have left over at the end of the year. But unfortunately, it's not so easy, because the price didn't stay constant at 70 Rand. There's inflation, there are different suppliers, there are all sorts of factors that come into play. If you study economics or business studies, you would know more about these. But the truth is that the price of the CDs has not stayed constant, it has fluctuated. The CDs that we had an average price of 70 Rand, but then the CDs we bought in April cost 60 Rand. Then in August, they cost 90 Rand. There was a massive price rise. And then in November, the CDs only cost 80 Rand. So there's been a big change in prices. And now the question is, are we going to use the 70 Rand here, the 60 Rand, the 90 Rand, or the 80 Rand, or are we going to do something completely different to work out how much one CD costs? The answer is that we need to work out our weighted average. We have to work out our weighted average with the CDs. Now, very important to understand how to work out a weighted average. A weighted average is not just adding these four prices together and dividing by 4. That would give you the average price, but the thing is that we bought 8,000 CDs at 80 Rand and only 4,000 CDs, so half that number, at 60 Rand. So there's a difference between the number of units that we have in the different prices. So what we need to do to calculate the weighted average, your rule is that you multiply all of the prices out. So in other words, 2,500 times 70 is your opening stock, plus 4,000 times 60, plus 3,000 times 90, plus 8,000 times 80. You multiply all of those out, and what we then do is we add up all of those prices together, get a total, and then divide it by the number of CDs that we had purchased at that price. Okay, I'll repeat that. We multiply all our purchases out by the price and get a total, and we multiply our opening stock out by the price and get a total, and then we add all of those four totals together and divide it by the number of CDs we have, and that will tell us what the weighted average price of one CD is. Don't worry if you're not 100% sure on what I was saying now. I'm sure that if I do the example now and show you the calculation, it will make sense to you. So to calculate the weighted average, what we're going to do is we're going to start with our opening stock. So our opening stock was, let's just write it down here, opening stock. There's no set format as to how this should be set out. Okay, but the way I normally do it is I put the quantity and the price in total so that we can see easily how much it is. So our opening stock was the 2,500 at a price of 70. So it was 2,500 CDs times by 70, and we put the answer over there. The good news is that they've actually given us the answer of 175,000. We don't have to calculate it, but sometimes in a question, especially one that's worth more than 8 marks, you would actually have to calculate it. So this 175,000 was our opening stock. So let's put it there. 2,500 times 70 was my 175,000 Rand. Then I'm going to add to that all of my purchases. And my purchases, there were 3 sets of purchases. So they were 4,000, 3,000, and 8,000. The good news, though, is that we can write these out one by one if we want to, but they've actually given us the total at the top here. We purchased 15,000 CDs. 4 plus 3 is 7, 7 plus 8 is 15. If you add all 3 of those numbers up, we get the 15,000. And if you add all 3 of these numbers up, you get the figure 1.15 million. So our purchases during the year were 15,000 CDs at 1,150,000 Rand. So let's write that down over there. Our purchases were 15,000 CDs at 1,150,000 Rand. I'm not going to put a price in here because our 3 prices were different. We bought some at 60, we bought some at 80, and we bought some at 90. So what we now do is we've got our opening stock and our purchases, and we add them together and get a total. And we actually add the number of units together. Remember, this is the number of CDs, 2,500 and 15,000. And this here is the cost of CDs in rands. So we're going to add both of these together, and we're going to use that to calculate the weighted average. So let's do it on the calculator. If I take my opening stock, there were over here 2,500 units. Let's type it in, 2,500. And then we purchased an extra 15,000. Let's add that, plus an extra 15,000. So that means that I had in total this year, I had 17,500 CDs for sale. 17,500 CDs for sale. And the total cost of those 17,500 CDs I can calculate in the same way. I'm going to add the cost price of each of them up together. So let's get the calculator on the screen. 175,000 Rand was my opening stock, and then I purchased an extra 15,000 CDs at 1,150,000 Rand, and that gives me a total of 1.325 million. So let's put that down there. 1,325, 000. Don't forget the Rand sign. So that's the total number of CDs I have, and their cost in total was 1.325 million. So how much was one worth? It becomes very easy to calculate the weighted average. What we do to calculate the weighted average, WA, we're going to take our total cost of 1.325 million. That's the total cost of all the CDs that I had available for sale, and I'm going to divide them by the number of CDs that I had, which was this 17,500, and that's going to give me the weighted average of my CDs. So let me just do that. I've still got the 1.325 million on my calculator. Divide by 17,500. That gives me a total of 530 over 7, which works out to 75 Rand and 71 cents per CD. So the weighted average is 75 Rand and 71 cents per CD. That's what one CD costs. And that is the figure that we can then write over here as our CDs on hand. They were each worth 75 Rand and 71 cents. So if we now want the total value, because remember the question is asking us, remember what the question originally asked, the question actually asked us the value of the stock on hand. In other words, the value of the stock at the end of the year, they are wanting to know what is the value of these 3,020 CDs that we have on hand at the end of the year, 28th of February 2010. Very easy. All we have to do is take this weighted average and multiply it by the number of units times by 3020. So let's do that. It's still in my calculator. You can round it off or not. If you round it off, you'll get a slightly different answer. It doesn't matter because the examiner will mark both answers correct. They'll mark it correct whether you've rounded it off or not. So I'm just going to leave that figure in my calculator and multiply it by 3020. And the answer that I want, the value of my closing stock on hand, is actually going to be 228,657 Rand and 14 cents. So let's write that down. Just check it again. 228657 and 14 cents. And that's the answer that they want for 8 marks. So it was quite a bit of calculating. They wanted to know the value of the closing stock. So the closing stock, just let's write it here. The closing stock was equal to the 3,020 CDs that we're going to multiply by the weighted average of 75 Rand and 71 cents. And that came to the answer that I have in my calculator of 22867 and 14 cents. 22867 and 14 cents. So there was a lot of work that we had to do to calculate that weighted average, but it was worth it because we've got 8 marks in the bag, which is a significant percentage of your paper. Make sure you know how to do this calculation, and make sure that you can calculate the value of the closing stock using FIFO as well, which is slightly different. Okay, let's have a look at the next question. The next question says, calculate the number of CDs that have apparently been shoplifted. Okay, so there's some trouble here. The owner of the business suspects that some stock has gone missing, it's gone stolen, and he wants to know how many CDs have apparently been taken, have apparently been shoplifted. So let's look back at the information and see what they tell us. They tell us here that if we look at the units, we started with 2,500 CDs, and at the end of the year, we've got 3,020 left over, and during the year, we purchased 15,000. Okay, so far, there's no problem. But they tell us that the CDs sold during the year were 14,400. Okay, so we sold 14,400 CDs during the year. We started with 2,500. We purchased 15,000. So actually, we should have had, remember we calculated it earlier, we should have had 2,500 plus 15,000. There were 17,500 CDs available for sale. Then we sold 14,400 of them. Okay, so let's see how many we should have had left over. There were 17,500 CDs available for sale, which is the 2,500 we started with, plus the 15,000 that we've purchased. And we've sold 14,400. So let's just calculate this. The number of CDs that should be on hand. That is equal to our 17,500. Remember, that is the figure that I calculated here by saying 2,500 plus 15,000. That's how many there were available for sale. But we sold 14,400 of them. So if we sold 14,400 of them, there should be 17,500 minus 14,400. That's how many we should actually have on our shelves at the end of the year. So let's calculate that. We're going to take our 17,500 CDs that we had available for sale. We then do our physical stock take, and we sold 14,400. So that means there should be 3,100 CDs on our shelves. So there should be 3,100 CDs on our shelves, because out of the 17,500 we had, we sold 14,400 of them. That's how many we should have, and if we look back at our schedule here, we see, oh dear, we've only got 3,020 CDs on hand at the end of February 2010. What that therefore means is that the difference between what we actually have and what we should have, that's the number of CDs that have been shoplifted. So from the 3,100 that we should have had on the shelves, we should subtract the 3,020 that we actually have, and we'll work out how many have actually been shoplifted. So the way we do that, let's do the calculation. So of CDs stolen, I'll just abbreviate it, is the 3,100 that we should have had minus the 3,020 that we actually have. And if you do that on the calculator, you actually will get 80 CDs. So this shop has had 80 CDs stolen. That's more CDs than are in my collection. I don't know about you, Luni, but the shop is losing quite a bit of money from the 80 CDs that were stolen. So we've got some more questions to go through, but I think it's about time for another break now.
All right. Mindset is let's take a very quick break, but don't go anywhere. We'll see you straight after this. Welcome back, Great Towels. I hope you guys are still enjoying your accounting lesson with Martin, so I'm not going to waste your time. Take us straight back to Martin.
Thank you very much, Looney. So we're still dealing with Tiger Music. This is this business that is having some difficulties with its CDs that have been stolen and various other stuff. And before the break, I calculated previously that this business has unfortunately lost 80 CDs due to shoplifting. And this is, we're going to answer the challenge questions just now, but this is a clear disadvantage of the periodic system. If you use the periodic system, you actually don't know when your stock is being stolen, because the only way that you can detect it is at the end of the period, and by that time it might be too late ever to recover the criminal or even to claim insurance money. You might not even know that those CDs have gone missing. So now let's look at the next question, and the next question is asking us to calculate the value of the CDs that have apparently been shoplifted. So don't get confused with the previous question. The previous question wanted to know the number of CDs. So they wanted to know how many physical units were actually stolen, and we calculated that it was 80 CDs. Now they want to know how many rands this business has lost. What is the value of those CDs that have apparently been shoplifted? So what we need to do is, the nice thing that when you're calculating the value of anything, if ever a question uses the weighted average system and asks you to calculate the value of anything, the value of cost of sales, the value of opening stock, the value of closing stock, the nice thing is you just multiply the number of units that you have. So it's usually going to be the number of units that you have. And once you've calculated the weighted average is like a magic number that you've calculated that you use in almost every question. You use it again and again and again. Once you have it, you use that to value your closing stock, you use it to value your cost of sales, you use it to value any items that have been stolen or lost or damaged. So if we want to calculate the value of CDs that have been shoplifted, we're going to take the number of units and we're just going to multiply it by the weighted average. And we know that there were 80 CDs that have apparently been stolen. And we calculated earlier that the weighted average was, here it is, there's my weighted average calculation, 75 Rand and 71 cents. Store that number, write it down, save it to the memory of your calculator. When you're doing a weighted average question, this is your magic number that you're going to use over and over and over again. So I'm going to take this figure, 80 units, and I'm going to multiply it by my weighted average of 75 Rand and 71 cents. Remember, what the weighted average represents is what one CD is worth if you take all the average prices and combine them and give each one a weighting. That's what the average price of one CD is. So if you want to know how many the value of the CDs that have been shoplifted, there were 80 that have been stolen. Each one costs 75 Rand 71. So the total value that I've lost is going to be 80 CDs multiplied by 75 Rand and 71 cents. And the answer comes to 30284 over 5. It comes to 6,056 Rand and 80 cents. So that's the value of the CDs that have apparently been shoplifted. One very important thing. Let's say that you've done something very careless, and in the previous question, the first question, you maybe left out some of your purchases, or you left out your opening stock, or you did something silly that meant that you didn't get the correct weighted average of 75 Rand 71. That doesn't matter. You can still get all the marks for the question and maybe just lose 1 or 2 accuracy marks in the whole question as it is, as long as you show that this weighted average is the figure that you are using in your calculation. So whatever number you calculated here, let's say you made a mistake and you got 72 Rand instead of 75 Rand. The examiner is going to check that your answer in 1.1.1 was carried through to your next question, and that you multiplied whatever number you calculated as the weighted average, that you multiplied that by 80 Rand to get an answer. You can get 2 out of 3 or even 3 out of 3 if you show that weighted average, and that is why please, please, please remember to always show your calculations, because the examiner is going to check that you used a weighted average in order to calculate the value of the CDs that were stolen, and like I've said, you can still get almost full marks for the question as long as the examiner can see what it was that you did. Okay, now the next question is just really some practical advice. This business is having some difficulties, and the question asks you to provide 3 points of practical advice to Tiger Music on how they should improve control over their stock. So when you're dealing with fixed assets, very often this type of question is asked in conjunction with another section. You could sometimes get it in manufacturing, very often get it in manufacturing or in cost accounting. You also often get this as an ethics or a controls question. You also get something linked in there. So this question is asking for 3 points of practical advice to this business on how they could improve control over their stock. So how could they prevent this stock from being stolen? Nobody wants to lose 6,000 Rand. What could this business do to stop itself from losing 6,000 Rand? Well, one thing that we could do is we could have better security. So I don't know if you've recently gone and bought a CD, but sometimes if I go into a CD store and buy a CD, there's often a security guard who doesn't let me leave unless he or she has opened my packet, looked inside and compared the slip to what I've purchased, so that I'm not able to shoplift any CDs. They check that what's in the packet is exactly the same that's on the slip. Or another thing that you could do is, instead of having security, you could have a scanner at the door. So a scanner at the door would be something where the CD has got a special tag on it, and when you leave the shop, then the alarm system sounds. If it hasn't been deactivated at the till, then they can see that you have not purchased the CD at that shop, or you have actually shoplifted it. Another possibility is storing the CDs behind the counter and display only empty boxes. Or they normally call them CD cases. So some CD stores actually do this. If you go into a CD store and you see all the shelves with the different CDs, and you open one of those CDs, you'll actually find nothing inside. So even if you take that box or that case and put it in your pocket and manage to sneak out past security with it, you open it up and there's nothing inside. You actually have to go to the counter and pay for it first before the person will go to the storage of CDs, get out the CD and put it into your case and give it to you and let you leave. So that would be another possibility. So here are 3 possible examples, some points of practical advice as to what this business could actually do to improve control over its stock. Let's just think of some more, just in case you don't like these ones. Another possibility might be to change inventory systems. So you could maybe change to the Perpetual system, because if you change to the Perpetual system of inventory, you know every day you calculate your cost of sales, and you know every day what the value of your trading stock should be. So what that would mean is that you would be able to determine immediately whether stock has been stolen or whether stock has been lost. But of course, there are some other advantages to the periodic system, which we're going to discuss now. Another possibility might be that you do more regular stock takes to determine whether items have been stolen. If this business only does a stock take once a year, then the chance of picking up a theft is not going to be very easy. Whereas if you do stock takes maybe at the end of every month or something like that, I'm sure you've been in a mall or somewhere where the CD shop is closed because they're doing a stock take. If they do this more regularly, they'll be able to detect theft a lot more easily and be able to put a stop to it. So here are about 5 points of practical advice. I'm sure that you can think of some others. It's quite an open-ended question, but make sure that when you answer a question like this, Put something in that is practical, put something in that actually makes sense. So don't give a really creative answer, such as put a disease into a package of CDs that has to be deactivated or something like that, that if a person steals it, they're going to get the disease. Or don't put something crazy like having guard dogs around every shelf or something. Put a piece of practical advice, something that the shop can actually implement. You know, another usual thing is that you have security cameras. That's often a very important answer to a control question. If you put security cameras in the store, the cost of installing the camera might help you detect theft and might let you follow up on people that have stolen your CDs. So there are many different answers, but make sure that they are logical and that they are practical. So that's the end of this exam question. Let's go back now to the challenge question that we had. So I asked you earlier to explain one advantage and one disadvantage of using the periodic inventory system as opposed to the perpetual inventory system. So I think, Looney, you said that there were some people that answered this question on Facebook.
Yes.
So maybe you can tell me some of the answers and we can write them up here.
Okay. Zakira Mansour is saying the advantage is it is a simple and cheaper system to use, and it is suitable for businesses that sell a variety of items where it is difficult to determine the cost price of the items sold. And then the disadvantage is less control of stock, as theft of trading stock cannot be detected, and trading stock on hand can only be determined by a physical count. Yes.
That's exactly right. Well done. That's an excellent answer. An advantage would be that it's very simple and it's very cheap because you don't have to calculate your cost of sales at the end of every transaction. You only simply count how much you have at the end of the period. And she also said that it is useful for businesses where it's quite hard to value the stock individually.
Yes.
So a type of business like that would be a grocery store. It's sometimes quite hard to work out the value of one banana. Sometimes people buy one banana, sometimes two bananas, sometimes a bunch of bananas, and it's usually sold by weight rather than by value. So in a system like that, it makes sense to use the periodic stock system. And that's the big disadvantage, is that there's less control over stock because you can't detect theft that easily. Some other answers?
Do you want some more answers? Okay.
Yes, please.
Shirley Guluja is saying the advantage, it is simple and easy to maintain. A simple inventory system is best for companies with small inventory to account during physical count. And then the disadvantage is companies are not aware of how much inventory is on hand until the end of the accounting period. And
Excellent.
then Tembwinkosi Mtsweni is saying the advantage is you don't need to have expensive computerized scanning machines or computers. And then the disadvantage is difficult to know how much trading stock you should have. Also difficult to know if trading stock was sold or stolen.
Exactly right. So from those answers, I see that people have got a really good handle and a good understanding of this periodic inventory system. Well done. Make sure you know the advantages. And remember that the question can be asked in the opposite way as well. They might say, name one advantage of the perpetual system. And then you would say that there's more control over it and you can detect theft. Or they might say, name one disadvantage of the perpetual system, and then you could say, instead of, because the periodic system is simple and cheap, you could say that the perpetual system is more complicated and more expensive. So that would be another possibility. So well done, Mindsetters. I'm really impressed with the answers that you've sent in.
You also asked earlier about the cost of sales calculation.
That's right.
And then Prince gave us an answer saying cost of sales calculation, opening stock,
Opening
add purchases,
stock. Yes.
and carriage on purchases, less closing stock. That's my answer for your question of cost of sales.
Okay, so Prince, I think that's 100% correct. Let me just write up that answer for you.
All right.
So when you're calculating your cost of sales under the periodic system, what you need to bear in mind is you're going to take your opening stock, as Prince has said. To that, you're going to add your purchases. You're also going to add your carriage on purchases. Remember, just in case you've forgotten, what is carriage on purchases? Carriage on purchases is basically any costs of transport that you need to bring the stock to your warehouse or to your factory. So if I'm paying somebody to deliver all the stock to me, that is called carriage on purchases. It's the cost of delivering the stock to me. Please don't confuse it with carriage on sales. Carriage on sales is the cost of getting the product to the customer once I'm selling it to that person. So we're going to add carriage on purchases, and we're going to add other purchasing expenses. Other purchasing expenses usually include something like import duties, or it might be some other costs that you might have, such as freight or something like that. And then we're going to subtract our closing stock, and that is actually going to give us the answer for our cost of sales under the periodic inventory system. So well done, Prince. That's exactly the right answer. I think that's about all we have time for today, Looney.
Thank you so much, Martin, for the lesson. Thank you for your wise words and your clever answers there. We
Very
really
welcome.
appreciate it. Mindsetters at home, thank you so much for tuning in and for talking to me on the Facebook page. Remember, we'll see you same time, same place next week. So until then, it's a goodbye from us.